Thank you for joining us today in this masterclass where the target or the objective will be to give us a closer or deeper understanding on liquidity, what that may entail, and how liquidity is important for digital assets, for trading, and for having efficient markets. My name is Saliba. I'm the CEO of Volpex. We are a boutique-style market-making company who have been providing liquidity to digital assets since 2014, approximately, so a few years in this space. And we basically are an algorithmic trading company. So we mainly develop algorithms which we then deploy in strategies across different markets with different objectives. So really the idea of today is to make sure that everybody understands up to a certain extent how we do this, the importance that we consider that liquidity has in different markets, and also what the rewards and the challenges are of markets which may be liquid and those that may not be so liquid. So without any further ado, we can get started. Our understanding is, first of all, maybe at the back, can everybody hear me correctly? Yes? Yeah. Thank you. So we understand that liquidity is very critical, and the most important thing to understand what liquidity is surely would be to define it in the first instance. So when we refer to liquidity, we are speaking about the efficiency or the easiness which you may have when you want to exchange an asset for a different asset. Maybe if we're looking at cryptocurrencies, so if you have a Bitcoin, how easy or fast can you convert a Bitcoin to perhaps a stable coin or to Ethereum or to any other cryptocurrency? The same applies for traditional markets. In traditional markets, a liquid asset could be, for instance, cash. So FX is super liquid. There's always going to be a high offer and a very high demand, so you can quickly match buyers and sellers. But if you look at, for instance, real estate, depending on also what market and perhaps what location, it can be more or less liquid. So if we talk about a very big property in a not so interesting area, it may take months, maybe years to be able to find a buyer. So therefore we understand that that's not too liquid. With cryptocurrencies, something very similar happens. So we identify the top cryptocurrencies usually by market capitalization. And those would always be the famous ones which we've all heard of, right? So we're looking at the Bitcoins, the Ethereums, the Binance coin, etc. Also stable coins, which come to fix a bit the problem of illiquid markets. But if we keep going down in the size of coins or tokens, as per se, you start to realize that the markets become less efficient. It may take longer to be able to exit or enter a position. And this is where the role of a market maker, which is what we do at Volpex, starts to become of interest. So perhaps Bitcoin doesn't need many market makers because there's already utility in the actual purpose of the transaction. But if you look at smaller tokens or new tokens that come to the market, they normally face a liquidity problem. The way in which this is fixed is by providing liquidity by looking at the metrics, which we understand that liquidity has to be measured. And this could be the depth of a given order book. This could be the spread, which would be the difference between the bid and the ask. But we'll soon see this here. So as I was mentioning, here you have common indicators, such as the main common or the most common, generally we refer to them as the bid and ask spread, which is the difference between what somebody is willing to buy an asset for and the price that somebody is looking to sell it at. And however closer they become, the spread would be closer, and therefore we understand it as a more liquid market. The second that there is a bit of a wider spread, you enter what's called slippage. Slippage is the difference that you can actually achieve by buying and selling an asset, and the price difference that you have to accept. And it can incur in big losses. And it also, of course, is going to be depending on the utility that that asset may have. This happens again across cryptocurrency markets, but also in any other traditional markets, be stocks, be commodity, equity, all of them. Likewise, the order book depth is a great indicator as to what real interest there may be for a given asset. So other than the price discovery, which would be the midpoint in an order book, which would be represented by the best bid and the best ask, what we find in the middle is what we consider the midpoint. The depth is going to be representing how many orders or how many buyers or sellers, depending on what side of the order book you are looking at, are willing to exchange that asset and at what price level. Maybe on the next slide, we can see this graphically. Here we are. So this slide comes to represent the spread of any order book. It's generic. This could be Bitcoin, it could be Ethereum, it could be Tesla shares. It doesn't really matter. What we see in the middle is the spread, which is the difference between the best bid and the best ask. And in this order book example, what we have is very different depth. So to see clearly what the depth would be represented like, we can see this slide. And this is usually a clear representation of standard order books, by where the closer you find the spread, the smaller the order size would be. And the further from midpoint, as you can see on both sides, usually it's an accumulated value, but usually it also represents that there will be more people willing to achieve a profit by taking exercise of the potential volatility of an asset. Which is why volatility is one of the main key features of digital assets, and also perhaps what attracts many people to digital assets, because it provides also benefit or potential for benefit and profit. But that will be something that we will discuss later on. The other two common indicators for liquidity, to identify liquidity within any asset class, would be trading volume. So how much does an asset become traded, or how much do we trade an asset in a given time period? And of course, the higher the volume, it means that the market would be more efficient. When you don't have a lot of traded volume, it represents that there isn't too much interest from the general public, and it also represents that the market is not too efficient, which allows for potential problems if you want to interact with that given market. Likewise, the market size. For the market size, it's the way in which we understand one market versus another. It's how we compare different markets. It's used as a benchmark. In cryptocurrencies, Bitcoin is the queen or the king, depends how you want to look at it. And we usually consider the Bitcoin to be a benchmark for against any other cryptocurrency or digital asset. So we always speak about dominance. The dominance of Bitcoin has reduced gradually, but simply because there have been new tokens with new protocols, new coins that come to offer an alternative in some cases, or not necessarily, but that means that it ultimately dilutes the whole market cap of the industry. When we talk about market cap, just not so long ago, maybe just a few months ago, a year ago, the whole market cap of digital assets or cryptocurrencies was estimated in approximately $3 trillion. Things have changed significantly due to market conditions over the last few months, and these days it's scraping the 1 trillion. So we are at a very big difference to where we were a few months ago. But this is common. Over the years, we've seen a lot of fluctuation. And again, this is also a direct impact and result of the volatility that we can experience in digital assets. In comparison, as you can see on the slide, the crypto market is estimated at $1 trillion, whilst in comparison, for instance, the equities market, global equities market, so all stocks and shares from planet Earth, are estimated approximately, and again, there's a lot of fluctuation, so don't take my word for this, but approximately, depending on the dates in which you're considering, you would be looking at 110, 120 trillion. So cryptocurrencies are still very, very small. They're at an infancy stage, but the growth has been exponential. If you consider this over a time period, the growth of cryptocurrencies as a new asset class is definitely quite promising. So we expect the growth to continue, but that is going to come, of course, with different challenges. In this slide, what we would like to point out here is the difference by volume, by market volume, therefore what is traded on a regular basis across different cryptocurrencies. So you can see how Bitcoin and Ethereum have a very significant relevance as far as volume goes. And then you would see in the smaller boxes in green, I'm not sure if it can be appreciated clearly because it's size, the map is a size map. So you get to see how it compares by size, representing the volume, one cryptocurrency against another. That's what you see on the left side. On the right side, what we can see are stable coins, which is used generally to be able to come in or out, exit or enter positions of digital assets. And that's why it has more volume perhaps than smaller assets, as you can see, for instance, compared to Solana or to Doge or Ripple, USDT has a very big impact. There's also other players. Some years ago, USDT was the only stable coin, and it was the go-to stable coin because there wasn't many other alternatives. These days, that has changed and it keeps changing, and it's found a very competitive landscape. So therefore, there are other stable coins which are coming up in volume and becoming a competition, or in other words, an alternative to being able to trade the most common digital assets and the smallest too. Here again, this is another chart which we found would be useful to represent the size, in this case, of the Bitcoin's market cap in comparison to regular stock companies. Bear in mind that this information is from March 2022. Again, many things have changed. You would realize that quickly. Based on my mental figures, I think Bitcoin probably has a market cap which would be 50%, perhaps 60% of what you see on screen. So we'll be looking at approximately 400, 500 billion is its estimated market cap today. That can change very quickly. Again, this is how volatile these assets are. But it also happens with the other stocks which we're comparing it with. So you may see some stocks here which in March were doing very well, and today they are slightly smaller. For instance, Tesla and many of the others that you can compare. But in general terms, Bitcoin's market cap is only equivalent to any given one stock, which could be a multinational company, and still very far from some of the bigger companies like Microsoft, Apple, and Amazon. This chart looks similar to the previous one that we saw by volume, but here we're actually defining the size by market cap. So therefore, how big a coin is based on the issuance and its value. So here you can clearly see the Bitcoin with a dominance of the whole sector of approximately 39%, still is very representative in our industry. Ethereum represents almost a bit more than half of what Bitcoin would be. And then, as you can see, the size that you see on the map is very representative of the different sizes by market cap of different tokens, not by volume. So it's very interesting to understand the difference between what's traded volume and then what's the actual size, because the size comes to say what people understand is the price which these assets should be considered for. Which is very dependable on whoever is looking at it. But ultimately is what people are willing to buy or sell an asset for. So it's quite representative. Now, the importance of liquidity, I think, is clear. We have explained that you may own a very valuable asset, but if there is no other counterparty which may be interested in buying the asset from you, all of a sudden it becomes illiquid. So this happens with assets of the real world and also from the digital world. And we think that this is also quite important to understand with cryptocurrencies, because the problem that comes to solve this, these illiquid assets, would be professional market makers who can make sure that spreads become narrower and the order books become deeper, and therefore make the sufficient attractiveness for these markets for somebody to want to either buy or sell the asset. So if you can buy an asset for $99, but you would then have to consider selling it for $95, it's not of interest to you, unless you're looking at very small differences between the bid and the ask, therefore a very narrow spread that becomes more attractive. And we understand that this is the importance of liquidity. Here you can see a very clear example of how the spread may widen, and therefore what occurs is what we understand as a liquidity crisis. Benefits. Well, we see three clear benefits of having deep order books and tight spreads, therefore liquid markets, which is, in the first case, it makes it very difficult to manipulate the price of a given asset. When a market is not liquid and the spread is so wide, so therefore the buyer and the seller are so far away, it makes the potential of manipulation much easier. So somebody can make somebody think that an asset is worth a different price than what somebody may be willing to buy or sell it for. Likewise, liquid markets offer stability and up to a certain extent addresses the issue of volatility too. So if you have a strong liquid market, it means that you're going to have stability in prices. There's not going to be so much fluctuation up to a certain extent. Okay. And of course, it helps to analyze the behavior of traders, because when there is a healthy market which is correctly priced, so therefore the price discovery is clear, it means that it's very easy to understand what the sentiment of people who are either entering or exiting positions may actually be. So it provides a lot of data analysis. I will not go into these details. One of the tools that we use as market makers and users in general to compare different assets in digital assets is aggregators. We define generally two main aggregators, CoinMarketCap and CoinGecko. And each of them have different readings of the same asset classes, which means that you cannot really just depend on one or the other. Here on screen, you have an example of CoinMarketCap, where they have, for instance, recently come up with their liquidity ratio, as you can see in the red circle. So they kind of classify from 1 to 1,000 what the ratio of liquidity may be for a given asset. Whilst here it looks similar, but it's from a different provider called CoinGecko, where what we find of interest is the spread percentage that they offer, which is what we were mentioning earlier, where the difference between the buyer and the seller is actually represented in a percentage for each asset, and this is also very useful. But neither of the both aggregators offer the same terms or the same kind of language. So usually it's a good reference to use both. And that would be how I finish my part. And now I'm going to allow my colleague Alex Fernandez to continue with the second part of this presentation, where he will be speaking to you about the challenges and rewards of liquidity provision. Thank you.
All right, thank you very much for the introduction, Paul. Hello, everyone. Alex here. So during this next section, we'll be talking about the challenges and rewards we can find in this crypto space. Paul has already defined the environment flawlessly, so now we are going to define the trading context, which are going to be the challenges, and that's something that's given. We cannot control it. And overcoming that trading context is what's going to allow us to achieve that reward that the crypto space has, which is that it has a high profit potential. All right, sorry. So the first challenge I would like to discuss is obviously liquidity. And in order to do so, I'm going to use a benchmark, a reference, which is going to be the stock market, because I think it's going to be easier to understand how the liquidity in crypto markets are if we have a benchmark. So for example, in the crypto space, we have more than 800 exchanges, and the volume for 2021 was 15 trillions of dollars. While in the stock market, we have 60 exchanges, barely 60 exchanges, and the volume for 2021 was more than 150 trillions of dollars. So if you do the numbers, you can see that we have 10 times more exchanges and 10 times less volume. So the liquidity is 100 times more fragmented, approximately. And not only the liquidity is more fragmented because of the exchanges, the number of exchanges and the volume, but also, the connectivity is another challenge here, because in crypto markets, we not only have centralized exchanges, which are what we are used to see in traditional markets, where there's a third party that's controlling the transactions and controlling the trading. We have centralized exchanges, and the main characteristic of this group is that they are super efficient because they use a hot wallet, but the disadvantage is that you need to deposit your funds in that hot wallet in order to do the trading. So it's less secure but more efficient. And on the other hand, we have the decentralized type of exchange, which, the advantage is that it's super secure because you are using your wallet in order to interact with another wallet. So you don't need to deposit your funds anywhere, but it's a bit more cumbersome when it comes to trade, right? Because you are using, again, your wallet in order to trade with another wallet. And in the middle, we have a new type of exchange, which is the hybrid type of exchange, which is trying to, again, combine the best of both worlds. Another challenge is regulation or non-regulation that we have in crypto. And this affects the trading because, and again, I'm going to use a benchmark. In the stock market, we have a procedure by which an entity, in this case the SEC, controls the trading of every market, and if they deem it's necessary, they can halt the trading of that specific market if, for example, the volatility spikes up, or there's some relevant news about that specific market, or essentially because if the volatility goes up, they can, if they deem it's necessary, hold the trading in order to protect their users, their traders, from this massive volatility. In crypto, we don't have a procedure as such, but a couple of months ago, we had a situation with Terra, which I'm pretty sure you all know about, and exchanges had to, delist, in this case, that market because the volatility went crazy. Another practice that we can, in the stock market, it's forbidden, is what we know as spoofing. In the crypto market, this is not forbidden, and I'm going to use an example in order to define what spoofing is. If I place an order in the order book, and my intention is not for that order to get filled, but only to use its market impact to manipulate the market, then I'm spoofing that market. And in the stock market, we don't have the SEC, but we have the Commodity Futures Trading Commission, taking care of monitoring all the markets in case someone is trying to spoof a market. And that's why the market impact in the stock market is a super relevant indicator, but in the crypto space, as spoofing exists, we cannot rely in the market impact in order to measure a market. And last but not least, we have the volatility, which is at the same time a challenge and a consequence. And here, once again, I have some references. As you can see on screen, on your right, you have the historical volatility for 2021 for both Bitcoin and Ethereum. I haven't included the tokens, more altcoins volatility in this chart, but they will go even above those levels because, as Paul was explaining earlier, the rest of the altcoins are less liquid. And on your left, you have the Nasdaq, and you can see how, on average, the historical volatility for Nasdaq is 3 times smaller than the historical volatility for crypto assets. At the same time, the historical volatility for the S&P 500 is 1.5 times lower than the historical volatility for Nasdaq. And gold, at the same time, is 50% less volatile than the S&P 500. All right, now that we've defined volatility, and volatility, I want to mention that it's our biggest ally and our biggest enemy, because we can profit a lot from volatility, but if things are not done correctly, we can lose a lot of money really quickly if we do market making without managing our risks. So in this part, I would like to discuss what kinds of risks a market maker faces and how to mitigate them. So again, as Paul was saying earlier, our goal when doing market making is to place both a bid and an ask, a buy and a sell order, and ideally these two would get filled on the long term. And let's say that we started with 10 Bitcoins and $200,000 doing market making for Bitcoin USDT. So if these two orders get filled, at the end of these two transactions, our balances would remain the same, but with a profit that came from the spread that we are running. So the first risk we need to mitigate is the inventory management, because these that I mentioned are ideal conditions, but in reality, prices move either up or down. And again, let's use an example. What happens if I'm doing market making for Bitcoin and the price starts going down because there's more supply than demand? So obviously, my algorithm is going to be buying tokens back all the way down. And we could potentially run out of balances because we are spending more USDTs than the amount of Bitcoins we are able to sell. And this is a risk for the market maker because we are, we may run out of balances on the long run, and it will be difficult for us to come out of that position. And also there's a risk for the market in that situation, because if we are the only market maker in that market and we run out of balances, the chances of a liquidity crisis happening increase, right? So there's a technique, a mechanism called hedging, and this is what you can see on screen on your right. And what we are going to do is, again, if we are going to do market making for a small market, and let's assume this market is Bitcoin USDT, and a trader comes into that market and he or she sells a Bitcoin into our inventory. So we said that we started with 10 Bitcoins and $200,000. Now, because of this transaction, we have 11 Bitcoins and let's say $180,000. So what we are going to do is that we are going to go to a bigger market, it's usually bigger, and we are going to sell that Bitcoin right away in order to reposition ourselves. So we've sold that Bitcoin right away, and now we come back to the small market with that money, and hopefully the spread for us, has been positive. And at the beginning we had 10 Bitcoins and $200,000, and at the end of these two transactions, we now have 10 Bitcoins and $200,050, for example. All right, so we know how to maintain a flat position over time, but now we are also exposed to the price of Bitcoin, right? Because as I said, if we start doing market making for Bitcoin USDT and we need both Bitcoin and USDTs, the price of Bitcoin is going to affect our portfolio value. Our portfolio may be worth $400,000 at the beginning, but if Bitcoin drops 50%, my portfolio is going to be worth $300,000 when this happens. And how do I mitigate this risk? So in this case, we can use derivatives, and with derivatives we have options, perpetuals, and futures. In order to keep things simple, we are going to assume that we will be using perpetuals, which are like futures, but they don't have an expiration date. And how this works is that at the beginning, in order to start doing market making for Bitcoin USDT, as I said, we need to buy 10 Bitcoins spot. So what we are going to do is that at the same time that we are buying those 10 Bitcoins, we are going to go short 10 Bitcoins using a perpetual in this case, so that if the price of Bitcoin goes down, I would be losing money with the spot, but I would be making the same amount of money realized with the perpetual. And the same thing happens if the price goes up. We are not going to make money because of the spot, because we would be losing that money with the perpetual. And it's interesting to notice that by hedging that risk, or by mitigating that risk, there's a new risk, which is the liquidation risk, because we need to be careful when opening short positions. As you know, when you open a long position, the maximum amount of money you can lose is 100%. When you open a short position, the maximum amount of money you can lose is unlimited. All right, and last but not least, we need to be careful with the API limits we have with our trading engines and the APIs and the exchanges we are working with, because you can measure your strategy in order to need 1,000 requests per minute, for example, and that's on standard conditions. But what happens when volatility spikes up? You will need to refresh those orders more often because the price is moving faster, and those requests, you might need more requests, right? And if your limit is 2,000 and then your algorithm suddenly needs 5,000 requests per minute in order to maintain your strategy as it is, then your strategy is compromised. And how do we prevent that from happening? We can ask exchanges, because as I said, if the market making is not doing a good job, it's not only a risk for the market maker, but also for the market. And in this case, it's in both interests, the market maker and the exchange, for us to have higher rate limits. Because if the volatility spikes up and we need to refresh our orders more often, we will be able to do so, and we will be able to maintain liquid conditions under every scenario in terms of volatility. All right, and I think I will let Paul continue with the conclusions.
Thank you, Alex.
Thank you. Thank you.
So we're actually quite tight on time. So conclusions are very clear. Markets which are not liquid benefit from having a professional market maker to make sure that those spreads are tight, that the books are deep. But of course, magic cannot be done by any market maker, so you cannot trade with yourself, at least you shouldn't. And therefore, you're always going to be needing participants. So no matter how attractive you can make an order book, if nobody wants to trade the asset, it's not going to take you too far. So that's what we do at Volpex. I will not extend myself any longer. We have to be very respectful with the time. It's a shame we only had 30 minutes. We have tried our best to concentrate everything in the 30 minutes. So we now have a session of 10 to 12 minutes for questions and answers. So anybody who feels they would like to clarify any of the terms, we'll be happy to address those and try our best to reply. And otherwise, we're going to be here. We're fortunate enough to be the first masterclass of the Lugano Plan B event. So you can always reach out to ourselves or to our team members in order to clarify anything that you would like to discuss with regards to trading, markets, liquidity, volatility, or anything related. So thank you very much, and please let us know if you have any questions.
You showed a slide you flipped through that had algos and the market. Can you go back?
Sure.
This one. You didn't explain this one.
No, as I mentioned, we're not. Yeah, we don't have all the time in the world, and we would have loved to. This kind of explains what we do, sort of in a nutshell. What we do is we develop algorithms, right? An algorithm is basically a set of rules which would be spun by an idea. So if we consider that there is a way to achieve either a profit or increase the volume of an asset, what we would do is we would design an algorithm with a set of rules which we can then combine together, which by combining them, what we create is a strategy. The strategy then gets deployed on one of our trading engines, which you can see here, engines 1, 2, and 3. We have more engines, but generally we would deploy them depending on the exchange where you want to trade. So it can be centralized, decentralized, or hybrid. And then the execution takes place at one of these venues. So it could be anything from Bitfinex to FTX, Binance. We're pretty agnostic in that sense. After we execute the trades, what we do is we analyze the data we can extract. And that's where the reporting comes into place, which is super important for us. Once we can analyze the reporting, we would then try and achieve or maximize or fine-tune the algorithms to be able to improve our P&L, our profit versus the loss, if that's what we're trying to achieve, or otherwise to increase volume, since some exchanges would be paying us to increase the volume of certain trading pairs.
Yeah, this is maybe a bit technical, but what is the effect of no taker fees on Binance and KuCoin recently? I mean, in book terms, if you can say anything about that, I mean, without disclosing your IP.
Sure. No. So it's a very valid question. Ideally, we would have liked to explain the difference between maker and taker fees by where a maker posts orders on an order book without lifting or without crossing the barrier of the midpoint. So therefore, it adds value and orders and therefore depth to any given order book. And a taker order, just for the general public to follow us on this conversation, would be when somebody actually removes liquidity from an order book. And that usually is done in order to exit a position in a very short time frame. So you can post an order, but then the price has to move in your favor for that order to be filled. What a taker order is an order where automatically you are willing to accept an order which is on the other side. Usually, exchanges historically have disencouraged taker orders by increasing the fees. So therefore, you may find exchanges, which is very common these days with the exchange fee wars, where your maker orders would be zero or very close to zero, but to disincentivize you, they would place 0.1, 0.2, 0.5, even higher in some exchanges for taker orders. The question relates to why or what effect it may have to have zero taker orders. The effect could be quite negative, and it's quite of a bullish strategy from some exchanges. So once the war of maker go into zero, you cannot go much further. You can offer a rebate to incentivize volume on maker orders, but when you start playing with taker orders going to zero, you're actually allowing for the highest volume to come through your exchange at a cost of the actual asset that you're trading. So for very liquid assets, we see that won't have a massive impact, quite the opposite. It may draw more volume and attention, and it will facilitate strategies to be able to be more effective. But with those order books or those assets which are not so liquid, we understand that this could be quite detrimental in the fact that what they do is they reduce directly the liquidity that may be on an order book. So if there are not many market makers or not many users for an asset, we don't find it to be too attractive or too positive for the growth and environment of such asset.
Hello. You said before that the competition among centralized exchanges has become very fierce. And I was wondering, do you see a market opportunity in moving towards innovative order books like Uniswap V3 rather than being stuck to the centralized exchange world?
Yes. So this is in many ways the reasoning for the growth of decentralized exchanges is with the development of what is denominated AMMs, which stands for automated market makers. So these are protocols and systems that have been designed to avoid having an order book. It comes with benefits, but also it comes with risks and implied costs, which are very interesting and we're still defining. So in some circumstances, it's very user-friendly, but if you actively trade on a regular basis, it cannot be so attractive for many players. So it's a concept that keeps developing, and we have found recently some better solutions. But the fact that you cannot have an order book generally on a decentralized protocol is a big limit. So this is why new solutions are coming to market. We still understand that's in an infancy mode, but we do have high hopes that this could become the future of trading as we know it. Okay, don't be shy. Any more questions? Yep.
So, okay, thank you. I have a question. As a market maker, do you have also some triangular arbitrage strategies that you develop with your team or not across different pairs and at different exchanges?
Absolutely, yes. Again, we're very time constrained, so we cannot go into everything that we do. But of course, when you have a structure in place which allows you API connectivity to over 100 different exchanges, it would be not the smartest move to not reap the rewards which may show up, as you say, with potential triangular arbitrage opportunities All of this, we focus it on our department, which we consider it prop trading, proprietary trading. So there what we do is we trade for our own profit. So we have different strategies which may try and bridge different price discrepancies between centralized and decentralized exchanges, for instance, or even within centralized exchanges for those assets which are not so liquid. And then what comes to play is the speed at which you can actually trade. So we develop APIs to these exchanges, and then we deploy them on our servers, as you can see on this slide. And the server collocation, for instance, would be very important when you want to play arbitrage triangular strategies. But yeah, this is something that we do, and we keep fine-tuning and developing. Alex is in head of that part, so if you feel you want to speak about that later, we're happy to do so. Okay, yes.
Sometimes when the market goes down, we see the order book that goes empty very quickly. Do you know if there is some agreement with market maker that have to stay on the market when it goes down, or most of people that do arbitrage and everything goes away when the market goes down and the book is quickly empty?
Yep, very good question indeed. So this is how we try and identify what's a good market maker compared to a bad market maker. And it ultimately comes down to the intentions that they may have to be on an order book. So those market makers or professional traders who are there for the only reason is their profit, what they will do is they will switch off their algos and cancel all their orders as soon as the volatility is outside of their level of appetite, so to say. Whilst designated market makers whose interest may be represented by an exchange directly or by a token issuer, or who have already built into their algorithm the potential of accepting a certain loss parameter, will stay and remain in the order book. And this is, again, the very importance of liquidity and liquid order books, is to make sure that you have the highest uptime no matter what happens in the market. But you need to have a very stable and solid solution in place to be able to maintain positions over very high volatile moments. So this is what you will see as we progress in this industry, as it professionalizes and institutionalizes. Those switching on and off of different algorithms and trading strategies will not be so visible. But today, this is a reality of what we do. You're welcome. Gentleman here.
What is the frontier of your of the latency that you're working on? What is the fastest algorithm latency? And because I'm trying to understand what is the granularity you have to look at the crypto markets to just making sure that you're not missing important stuff happening. Because I know the crypto markets is slower in general than, let's say, FX market, much slower than that, but I don't know much.
Sure. I think this will be the last question because we have to allow time for our colleagues who are presenting. So really quickly, the straight answer is you need to be faster than your next competitor, because the fastest is the one who achieves the highest profit. Latency is an issue in any industry. By co-locating your servers as close as you can from the exchange where you're trading, you can overcome and reduce the latency. And just to give you a quick example, our fastest trading engine, or our most capable trading engine, has the capacity of 3,000 orders per second, which comes from traditional finance. Unfortunately, very few exchanges actually can assume that speed, but we are ready for that. So as and when they improve their API and their connectivity, we will be at the forefront to actually achieve those levels. But okay, well, thank you very much, everybody. It was a pleasure, and looking forward to speaking to you later.